Hey, hope you're having a good day. My name's Andy. My channel's Finding Value. And if you're new to the channel, please subscribe, click the thumbs up button, do all that cool stuff. Everyone who's subscribed, you guys know what to do. So today I want to talk about fundamental analysis versus technical analysis. And what have I chosen over time? Is one better than the other? I don't know. Let's find out. So fundamental versus technical. And I know there's a big debate. Which camp am I in? You'll find out. So technical analysis, they use historical chart patterns to predict future trends or price movements. And basically, technical analysis is using what the market is showing us. It's a way to see the market without all of the noise. Ultimately, you only have market signals. So in this camp, why use anything else? Now on the other side, fundamental analysis, you use models or analysis of intrinsic value, perhaps, of a company. And I'll be honest, commodity companies kind of buck this trend as, at the bottom, everything looks pretty bad. Their balance sheets look like garbage. At tops, they look absolutely wonderful. So really what we look at for fundamental analysis is look at future demand of their products, of whatever they produce. Look at the price and the costs for those companies and to produce that product. What are the supply-demand imbalances for the future? That is your fundamental analysis, because price is the most important thing to a commodity producer. It is the most, bar none, most important thing, is the price of what they sell, that commodity. And here's where I sit. I think they are both of them are needed. 100% I believe in both that are needed. Technical analysis tells you signals that you cannot get from fundamental analysis. You just can't get it. And fundamental analysis will give you signals about the future that technical analysis can't give you. So I think understanding what signals to watch is important to be successful, and the correlations between assets. That is what's important in technical analysis. And fundamental analysis will say, hey, look, the deficits are in the future. We know this stuff's coming. Now we just have to look at the signals in the market to tell us when the game needs to be played, when we need to put the chips on the table, when we need to take the money and load up, when we need to grab the keys to the truck to put the assets in the back of the truck, right? And market conditions here. This is what tells us the timing. This is what tells us when to load the truck up. So we've got real estate's the driver of inflation. That's really what it is. And I'll go over other video clips and show you why I think that. Inflation drives yields. And the reason it drives yields higher is because it creates negative real rates. And negative real rates, everybody wants to sell bonds, which drives the yield price of bonds higher. Inflation drives gold and commodities higher. So it's not just supply and demand, it's also inflation. It's all of it. Inflation drives gold higher, which drives the whole commodity complex higher. Rates drive bonds and stocks lower. Higher interest rates do. So they drive the risk-free return on treasury yields higher. And when you have a higher yield on bonds, or the treasury bonds, people are less willing to speculate and take the risk of stocks. So they put their money and park it in bonds that have higher and higher yields over time. And what this does is it drives money to rotate between sectors when these market conditions change. Real estate is really the driver of all of these changes, which is really a reflection of demographics. Now, this could be a huge debate here, and this is just my opinion. And I want to make sure everyone understands that these things are my opinion. And what I've found is that real estate is really the driver, which is really demographics is what drives inflation. A larger demographics has a higher demand for real estate, and real estate is the entry point or the gateway for money to get into the system of everything. Residential real estate. So how to understand all of this? I'm going to do an analogy here, a race car. A race car is our vehicle of our investment. It's our choice. It's Uranium Mining Company is our race car. That is the race car. What we need to do is we always need to watch our temperature and pressure. And that is really the market conditions. That is real estate. The temperature and the pressure is what tells us real-time feedback on the race car on the health of the engine, oil pressure and the coolant temperature and the temperature of the oil. If those are all in check, keep the pedal down to the metal and go. Now, keep in mind, we always watch temps and pressures to ensure we are good. We always watch market conditions, the real estate, which is those indicators, inventory, days on the market, real estate prices, interest rates. We watch all of this to ensure that we can keep our foot down on the pedal, which is buying. We are game on with commodities when we are fully warm and we have good pressure, so to speak. When the temps exceed safe limits, when we hit an oversupply state of real estate, when prices start to drop, when inventory starts increasing, when days in the market go way higher, that's our indicators that real estate is going to go in the opposite direction. We need to throttle back our investments and we need to rotate out. This is obviously years away, but that's how you can tell. Is if we're buying, we need to look at our valuations, our ratios, and we need to look at the market conditions to see if everything's good. If everything's good, pedal to the metal, we can continue to cost average in. If the temps and signals are good and we get price pullbacks, there's no reason to throttle back. We keep buying. We look at the market conditions. We look at the dollar. We look at all these things. And if they're going higher, we keep cost averaging in. We keep buying. If the values are good, there's no reason not to. So the conclusion here is technical analysis gives us real-time data and chart patterns indicating of trends and reversals. Fundamental analysis gives us the health of a company and future demand forecasts, and that helps us choose our companies that we want to select. Ratios give us value. And tying this all together, using every skill that we can to acquire, will make us a deadly investor. I mean, we will just be killing it left and right. So, I've got some analogies in here. Hopefully those analogies are working for some people. But acquire as much skills as you can in this market. Fundamental analysis, technical analysis, use all of it. If it's at your disposal, use it. You're using YouTube to acquire more financial education. You're gaining more education on how to become a better investor. And that's what you're supposed to be doing. So what I'm doing here is I'm using everything at my disposal. I'm using technical analysis, fundamental analysis. I'm looking at momentum and charts. I'm looking at everything I possibly have learned to get an advantage or to get better timing on my investments. That's all we're doing here. Hopefully some of this is leaking into you guys and you can see it. I buy during the dead periods when everything's kind of calm, right before the storm. And then when the people come, the herd comes running in, I'm already there and ready to go. So hopefully you guys can learn some of this and apply it to your own investing, we'll call it technique, or your own investing style. Hopefully you can integrate that in. Everyone's different. No one's the same. You guys all have preferences on risk taking. Everyone's different. I understand that. And hopefully you can integrate some of this into your investments. Thank you for listening. This is Finding Value.